In this video, I want to talk about two dividend stocks that's potentially undervalued. And as I talk about my idea, let me know what you think in the comment section below. Also, companies in Australia related to battery materials seems to have gone through a tear. Talga is almost up 6%, Novonix is almost up 8%, and Orocobre is up almost 1.8%. And the catalyst seems like it came from President Biden looking abroad for electric vehicle materials. So I want to share my thoughts on that and how that might impact some of the companies I just mentioned towards the end of this video. Now, if you learned something new, consider gently smacking that like button right there, and that will help this video to reach more people. And if you really like what I'm doing, want more content, tools, and be part of my Discord server, consider supporting me via Patreon. Link is in the description box below. As usual, this video is not financial advice or recommendation to do anything. It's just entertainment to hopefully brighten up your day a little bit. So without further ado, let's go. Okay, so this is the thing. If your portfolio is filled with stocks, it's pretty hard to stomach through a market correction of 40 to 50%, even if you have done your research. So for my own portfolio, in order to sit through some of these market corrections, I actually started my investing journey via dividend stocks. And to many people, I can hear the disgust coming through the camera going,
Ugh, boring stocks with strong cash flows and pay me a passive income. Give me a f***ing break. We want the 10 baggers so that I can wave my credit card in the air like I just don't f***ing care.
Alright, gossip girl, you do you. But I want a solid foundation in my portfolio so that I can sit through these storms and actually get to a 10 bagger. So the question is, how do we start screening for these high quality companies? Let me show you. It doesn't really matter what you use to screen for these companies. What's more important to me is the set of criteria that I used. This tool, if you are interested, this tool is called Finbox. I'm not sponsored. It's just something that has helped me with my process. So when it comes to my criteria, the first one is market cap. With Australian companies, I'm not really interested in companies below 500 million, just because the likelihood of finding a company with strong cash flows below 500 million is less, if you will. And then when it comes to EV free cash flow, this criteria is to help me find companies who are self-sufficient, who don't need to tap the capital markets for money. When you have a company who's constantly burning money and cannot sustain themselves, they inevitably will have to ask people for more money. And in a high inflation environment, I just don't think that is a good idea. So between 0 and 16, that's a sweet spot for me. And then when it comes to PE ratio and the average PE, that's just to help me filter out companies. You can set your own criteria if you want to. And then the EPS forecast, CAGR over 2 years, just means what is the estimate earnings per share growth compounded annually over the next 2 years. What I'm looking for are companies who are anticipated to grow positively over the next 2 years. So this is a list of companies, and without basically boring you, I have done some of the hard work already. But before I do that, I just wanted to let you know that if you want to know more extensively when it comes to my screening process, I actually documented in this video right here, which is how to screen for high quality stocks in 3 steps. And also in this video right here, how to beat inflation and screen for winning companies. Anyway, the next step that I do is I take that list of companies, I plug it into Morningstar, and then I am trying to essentially see whether there are any companies that's so overvalued that it's not worthwhile for me to keep investing more time researching the company. And it turns out that there's only a few, and Adairs turns out to be one of the companies that's considered fairly valued, even though there's a little bit of a discount here between their estimated fair value and the current close. Nevertheless, this tells me that there is some incentive for me to keep going. And the step after this is for me to enter Adairs into a simple DCF model and see if it's even worthwhile for me to put in even more time to research about the business model, how they're performing, so some of the more qualitative factors. This template, I have built it for my Patreons. The whole idea here is to keep everything really simple, to encourage people to learn more about valuation. So I've actually made the template public, and this is version 1. It's in the description box below. You can help yourself. And if you do have any feedback in terms of how I can make this better, let me know as well. In this very simple DCF model, there's 4 steps. The first step is entering some of the basic assumptions. So let's go through that. So to find the tax rate, what we can do is I use a tool called Ticker. You go to financials, and then you go to income statement, scroll all the way down to the bottom, And you can see that the effective tax rate is anywhere between 30 to around 27%. So for sanity's sake, I am going to put 30% here. This version doesn't currently take into account increases in tax rate, but the next version will. So you got to bear with me on that. When it comes to the discount rate, if the company is more stable, mature, predictable, then we want to go with something a lot lower. So anywhere between 6 to around 7%. And if it's something that's like highly speculative, high growth, then we want to go with a much higher discount rate. For Adairs, I put in 8%. And the perpetual growth rate is basically assuming the fact that at some point the company will plateau out when it comes to growth. And generally speaking, we put the country's GDP growth in here, and I left it as 3%. And then the EV EBITDA multiple is, we just go to ticker, go to valuation, and then we're looking at Adairs. So we will go to next 12-month EV EBITDA. And what I'm looking for is the historical average, which is 6.44. Okay, cool. So I put in 6 times here. Transaction date is just whatever the date that you're doing the valuation on. It does make a tiny difference, not that big of a difference, but I like to just date it just so that I know what assumptions I made in the past. Fiscal year end, that's important, but for Australian companies, it's generally 30th of June. And then the operating cash flows, debt, cash, capex, and EBITDA, I put in sources on where you get that information from, so that should definitely help you. Step 3 and 4 is really where we build our assumptions. And it's really important to me that I build a set of very conservative assumptions, because even if I'm wrong, I can still generate a good return. Well, that's my mindset, at least. And I have built in base case, bear case, and bull case because it's always about managing a set of probabilities. Things will never pan out the way we expect, right? So when we are at step 3, and the first thing that we should fill in is operating cash flow growth rate. What you can do is go back to ticker, go to estimates, and then let me move my portrait, and then we are looking for operating cash flow, which is here. And you can see that the operating cash flow is really high at a compounded annual growth rate of 26%, which means that every single year is going to grow at approximately 26.4%. That's a bit too high, and the pandemic have definitely accelerated that. So maybe what we can do is we will do 2020 to 2022. So you can see that, okay, operating cash flow is not expected to really grow at all. Now, part of the reason, if you haven't done the research, is that they are starting to invest in their distribution warehouse. So there's going to be a lot more outgoing money to invest in their infrastructure. So from that perspective, we can build in a 0 in terms of base case. And I think that bull case, we can go with something just a tiny bit higher. Let's say we'll go with 5%. And then bear case, we go, you know what? They suck, and the operating cash flow is going to be decreasing -5% over the next 5 years every single year, right? So I think these are fairly reasonable assumptions, okay? And then capex. When it comes to capex, this is not the best way to express this, but what I did in the model is I expressed capex as a percentage of cash from operations. So if we pull up the calculator and then we'll go 7.53 divided by 97, which would be around 7%. So capex is going to change all the time, but I just want an average so that we can get going with this valuation. So it's around 13%. So I put 18 because I looked at it historically and I wanted to be a little bit more conservative with my capex number. So I put 18. I've kept this constant between base, bear, and bull. And then let's look at EBITDA growth rate. EBITDA growth rate is around 43%, which is pretty high. So we're gonna dampen our expectations a little bit. So instead of putting 43, I've basically dampened it down a lot more to 25 for bull case. Let's say everything goes according to plan, 25%, 15% for base case, and then 10% for bear case. Now, the reason why you don't wanna be overly optimistic is, again, things just don't pan out the way that we expect it to. So if we're a lot more bearish and things turn out to be a lot better than what we expect, that's great. I'm happy about that. The last step is to assign some probabilities to the bear case, base case, and bull case. And I've assigned a 10% probability to bear case because we were already really conservative. So I just think that the probability of that happening is a lot lower because we already made some very conservative assumptions. when it comes to base case, because of the conservative assumptions, I'm a lot more confident that the base case will happen. And then best case scenario is, bull case, which is what the analysts are expecting. So I'll put 15% here. So taking into account the probability plus the upside of the different scenarios, the expected upside is around $2.89 from today's price. And this is over a 5-year period. So the internal rate of return is approximately 15%. So there's definitely incentive for me to keep digging and keep learning about the business. If the IRR is less than 15%, I'll probably just stop. If it's negative, I'll completely just don't even touch the company for a while. What I like to do after that is I like to come to Simply Wall Street and then look at the balance sheet health of the company. So you can see that for Adairs, the short-term assets doesn't cover the short-term liabilities. Now, this is not a deal breaker for me, but I honestly prefer when a company have enough short-term assets to cover the short-term liabilities. Just so that I know if there is some kind of sudden shock or whatever event happened, they wouldn't have any problems addressing the liabilities. Now, if we just keep going and then look at debt to equity ratio, let me move my portrait. You can see that they have no debt and with $22 million worth of cash. So from a balance sheet health point of view, quite healthy in my opinion. I will be worried if they have a lot of debt. Like for example, I'll be a lot more worried at this point when they have a crap ton of debt. Because this is an e-commerce company with a retail presence, I like to look at the organic search traffic and see how it has grown, because this is definitely a competitive advantage and a moat, because it's really hard for any e-commerce company to catch up to you once you build an advantage this strong. I use a tool called SEM Rush for this, and I pay for this because I currently consult e-commerce companies anyway, so I use it for work. But there are free tools like, for example, Alexa that you can use that will tell you some insights about, how the website is ranking, so on and so forth. What I'm looking for is two things. First, I'm looking for a general uptrend in organic traffic, and that tells me that the company have invested quite a large sum of effort into building content for Google. And this is an advantage that for a competitor is going to be really hard to catch up once you're at this stage. So currently they are generating 1,073,000 sessions per month. And that's absolutely incredible, right? So next thing that I look for is I come to the brand traffic trend. And what I'm looking for is branded traffic to decrease over time. The reason for that is that branded traffic are people searching for Adairs. Adairs, quote cover sets, whatever the case might be. They're already existing customers. What you're looking for in e-commerce and building an e-commerce company is you want new customers. You don't want customers who already know you. So you can see that from June 2020, the branded traffic for Adairs is around 61%. And then over time, it decreased to about 55%, which is really, really good to see. The last thing I like to look at is Google Trends. And I use this as a form of gauging customer demand and also how they have built up their brand relevance over time. So I just put in Adairs, Sheridan, and Bed Bath & Table. These are essentially the competitors to Adairs. And we want to look at a very specific geography. So I'll put in Australia, 2004 to present, so that you can really see how things have changed over time. And you can see that in the beginning, Sheridan was absolutely destroying it. And over time, they started to become basically plateau out and became less and less relevant. And Adairs have really taken off, which is a really good sign that they've built a strong brand, potentially a strong customer base. And this is a really good sign. You can see that the gap between Adairs and also the other two is quite big. From my perspective, Adairs is not a to the moon, boys type company, but it's a strong cash flow, efficient business with growing loyalty. But what bothers me about Adairs is that their dividend payout ratio seems a bit undisciplined. There are years where they pay 70 to 80% of their earnings, and then some years they pay 30 to 50%. Now it's important to note that a company pay a dividend because they're running out of ideas to invest in their company. Adairs is just reaching $1 billion market cap. Surely there are more ideas to invest in, like for example, logistic warehouses, which they are investing in currently. But what about e-commerce infrastructure, machine learning for better upsells and cross-sells? So even though there are upsides, the brand is growing and so is the search traffic. It's just a turnoff for me with this undisciplined dividend payout ratio. So currently, Adairs is high up on my watch list, but I haven't decided whether I want to pull the trigger on this. But the next dividend stock, I did pull the trigger. So let me explain. The next dividend stock is a US company, and it's a really old US company called Bristol Myers. Now, this company, for those of you who don't already know, it was founded in 1887, and it has a strong focus on products for hematology, oncology, cardiovascular diseases. So they are definitely not everyone's cup of tea, but I got interested in this when Warren Buffett decided to add a position in Bristol Myers back in Q3 of 2020. The first thing that I like to do is I like to come to Morningstar and then look at the valuation gauge to see whether if it's incredibly overvalued, so that I just completely stop. But it seems like Morningstar is saying that Bristol Myers is trading within a range that's fairly valued, and they do have a wide economic moat as well. So that was enough incentive for me to keep digging. And then following the same thing that I did for Adairs, the next thing that I did was I built a very, very simple DCF model. So I'll go through the results with you. And I put in BMY. Tax rate is, I did the same thing and it was around 15%. Discount rate is a bit lower compared to Adairs because this is a super mature company. And I put in 6.5%. Perpetual growth rate is essentially US GDP. And EV EBITDA multiple is, we go to ticker, go to valuation, and then 5 years. The next 12-month EV EBITDA is around 11 times, and that's what I have. I've done this DCF model in the past, so I just dated it just so that I know what date that I've made these assumptions. And then the operating cash flow is basically the same playbook. When it comes to financial statements, you do the same thing. You go to ticker, you look for this information in these different statements. And then the last thing that we need to do, let me zoom out, is basically build out the assumptions for the base, bear, and bull case. So let's go through step number 3 first. When it comes to the operating cash flow, go back to ticker, and then I go to estimates, go to operating cash flow, and the operating cash flow is going to grow at around 18%. So if I zoom out a bit, and then let me stretch it to show you why I decided to zoom in, you can see that there was a big change between 2018 to 2020. And one of the bigger reasons for that is that Bristol Myers acquired a company called Celgene in 2016, and they're slowly digesting the business. The big change is not very likely to keep occurring like this. I just prefer to have a more dampened expectation. If I change it to 2020, you can see the growth rate is around 18%. And I think that's a lot more reasonable than a 20-25% growth rate when it comes to the operating cash flows. But just because it was 18%, I put a 15% bull case, 10% for base case, and then 5% for bear case. The idea here, again, is to be really conservative so that even if I am wrong, I can still be in the green, essentially. And then CapEx, I do the same thing. We just look at CapEx as a percentage of operating cash flows. And again, just I wanted to keep noting this, that it's not the best way to estimate CapEx, but it's just one of the ways that I found to help me keep going with the process. And then EBITDA growth rate, you can see that the EBITDA growth rate is negative. So let's go with a negative growth rate, right? So I went with a base case with -4%. And let's say I'm optimistic that they're going to grow their EBITDA by 5%. And I think that's reasonable. And then I think with the bear case, I went with a -10% EBITDA growth rate. So basically their EBITDA is declining. But most importantly, their operating cash flow is growing, which is good. Then the last step is assigning probabilities. Now with bear case, we're already pretty conservative. So I think 15% is reasonable, 70% for base case is reasonable, and I think it's reasonable for the bull case as well. So there is a $112 upside and a internal rate of return of approximately 25%. So there is enough of an incentive for me to keep learning about the company. Again, I just want to reiterate that these simple models is not to help you make decisions, but just to help you choose whether you want to spend more time learning about the company. That's all. So the next thing I like to do after that is do the same thing as Adairs, but this time I'm going to change it a little bit. So before I look at the balance sheet, go to financials, go to ratios. This is a good habit to have anyway. You can look at the return ratios of the company. And generally speaking, you want to compare the returns with other companies of a similar size, of similar industry. And you can see that the return ratios for Bristol Myers looks pretty awful, like it sucks. And I was really curious that before I moved further, When I saw this, I was like, why is it that their return on equity is negative and their return on assets and capital looks awful? And it was pretty good before. Then I went to the income statement and I was like, where are these extra expenses coming from? And it turns out that they had to write down one of their R&D expenses as part of the Celgene acquisition. So that's one of the reasons why it's dragging down the performance for the company. And realizing that, and then I'll go back to the ratios, and from that perspective, I was like, okay, so that's probably one-off, and it's unlikely that will happen again. So I gave that a pass. And when it comes to the balance sheet, I do the same thing as what I did before, and I'm looking for whether there is enough current assets to cover out the current liabilities, and it definitely does. There's more than enough. So that means in the short term, any external events, any shocks, they should have no problem covering any of their liabilities. And then when it comes to debt to equity ratio, let me move this and let me turn off cash. You can see that they have a lot more debt compared to, like, for example, Adairs, and they didn't have that much debt before. Now, it's important to understand why they have debt. So when I did my research, it turns out that they're using debt to fund the acquisition for Celgene. That's why there is a lot more debt and a sudden spike when it comes to equity as well. So I think over time, this should come back down and equity should go back up. So that's why it's not a big turnoff for me. It's a really big turnoff if the debt is approximately 200% of equity, but it's at 122, so it's honestly not too bad. And then when I look at the cash, they have $13 billion worth of cash. So that's plenty of cash to even do some new acquisitions, more R&D. So from a balance sheet point of view, definitely strengthen balance sheet for me. So the cash flow for Bristol Myers is really strong. It's a good business with even better upsides than Adairs. So I've added this to my portfolio over the last couple of weeks to the collection of value stocks that I have. But they also have their own problems, owing potentially $1 billion to the IRS, which is the ATO equivalent in the US, and a potential lawsuit. I've done my own research, so that's something that you have to dig into a little bit further. Now, one more thing I want to mention before we do a portfolio update is that I generally blend my fundamental analysis with technical analysis, like basically reading the charts. And I use TA as a way for me to gauge market psychology and also manage my own risk. But for the purpose of all of you, I didn't want to confuse you with looking at charts, and I've only included talking about charts in my Discord. So if you want me to do more when it comes to technical analysis and you're interested, can you let me know in the comment section below so that I can try and incorporate it in future videos. So just a quick portfolio update. My CMC market side is worth about 94,000 Australian dollars, and I'm using ShareSite to track my portfolio because it looks so much better. And on this side, I actually have not made any changes because I've been just looking for opportunities, honestly. And I still have around 7,000 that I need to allocate. I know I keep saying that, but I am looking for opportunities and I'm taking my time. But the one thing I do want to point out, and I keep pointing this out, is that for my portfolio, at least for this side, you can see that WAX, Argo, VTS, these are really, really safe. And they eat up a big percentage of my portfolio, especially WAX and Argo. So these are almost like value stocks, if you will. That's why when there is a market correction, my portfolio doesn't draw down 50%, just because these blue chips or mid caps, they're really stable and they compound my portfolio over time. So that's why with my portfolio construction, I like to have a very solid foundation, and then I like to have growth stocks on top of that, just so that even if there is a drawdown, I can sit through the drawdown, no problem. With my US portfolio, I've made quite a few changes. So it's currently worth around 37,000 USD with 2.6K in cash. And with this portfolio, I have added pretty extensively into Bristol Myers, and I have actually built up a decent position in Regeneron as well, which is a similar company to BMY. And when it comes to CVS, I have not moved it since I've added a position in CVS. And the rest, I am really happy with what I have. Now, GoPro and Dropbox are free stocks given to me if you do decide to try stake for yourself. I'm not sponsored, but if you do want to try stake for yourself, I left the link in the description box below. Now, I want to talk about one more thing here. Many of you have asked whether I am worried about Michael Burry shorting Tesla. I'm not worried one bit because of two reasons. Firstly, my foundation in the value side of my portfolio is really sound. So even if there was a big correction, the damage will be dampened by the safe side of my portfolio. And the second reason is that I am not coming from the perspective of Michael Burry is wrong and I am right. I actually want to point out that early in the year, Tesla's valuation probably did get out of hand. So having a proper correction is healthy. You want the speculators to be cleaned out. You want the gamblers to completely clean out. So that way you can build a more sustainable growth ahead. And finally, I'm happy with the allocation I have. I'm happy with my research. So I'm happy to essentially sit through a drawdown when it does happen. So now let's talk about President Biden looking abroad for EV materials. Over the week, quite a few people sent me messages that Talga was up 6% for no apparent reason. Novonix was up like 8%. Vulcan Energy was up almost 5%. Or Cobra was almost up 2% just in a single day. And I was like, what is going on? And it turns out that part of the catalyst really is as part of President Biden's infrastructure plan, they are looking at Canada, Australia, and Brazil to essentially source some of those critical raw materials to US. And the thinking behind that, according to one of the sources at least, it's saying that it's not hard to dig a hole, but they're focusing on bringing that processing facilities into US, so more jobs for processing. Now, late last year, I've made multiple videos talking about the battery supply chain, and part of the problem with the battery supply chain is that everything is going through Asia to be processed, made into batteries. It generates a lot of GDP, it generates a lot of jobs, and they extract a lot of value from the battery supply chain. And when the pandemic happened, all the countries realized, holy smokes, we are so dependent on Asia. If they suddenly shut off the supply chain, we are screwed. So this is part of the bigger effort to localize and bring that supply chain back to domestic territories, whether that's the US, Australia, or Europe. So there are 2 points I want to make. Even though Australia is pretty important in lithium and also other rare earths and materials for electric vehicles, we actually extract a very small percentage of the value chain because we shipped off all our raw materials to China to be processed. We do very little of that processing here in Australia. And I think that even though we can sell those materials overseas, I would love to see us do more of the processing done here because that creates more jobs, creates more GDP, and that's good for us. So the second point, which I think is really important, is that the infrastructure bill is not passed. It's currently still proposed. So this is purely news. So the share price is reacting to the news. There's no fundamental value driving that forward. It's not making the company more valuable currently. I really think that the share price is just a short-term reaction. It'll probably come back down to earth eventually, but that's just my take on the situation. So thank you so much for hanging out with me all the way to the end. If you did learn something new, consider gently smacking the like button right there. Subscribe to my channel, click onto the bell so that when I release future videos, I can let you know. If you're still bored, I left a video on the screen that I think it's incredible to watch next. And as usual, Otto will always do the honors, and I'm gonna see you very, very soon.